The technical definition of a recession is two consecutive quarters of contracting economic output, or GDP. But in this video, I want to dig into what that really means in real terms and how it affects people in their day-to-day lives. I also want to look at if we're in one now, cover some past recessions, and approach how to invest in one. I'm Marcus Rogers, and this is Learn Wealth, a channel dedicated to making personal finance and investing simple and practical. If you're new here, please consider subscribing. Now, recessions have severe economic impacts on people, but they do come cyclically and can be prepared for. And that's why later I'm going to talk about how to invest in one so that you can maximize your return. Starting off, what are they? So, a contraction in economic output, or GDP. What does this mean? The way I like to look at it is you see a broad decrease in spending and income, because what one person spends is another person's income, and that cycles around the economy. It also has to do not just with their income, but how much credit they have, because that is something that they are going to spend as well. Since there's less spending and less demand for goods and services, recessions are always marked by a dramatic increase in unemployment. Now, when it comes to economics, I like to take the macro view. Let's take a look at the last 70 years of unemployment in the US. Now, this is for the US, but it generally applies to other countries as well. This is a graph of unemployment. You can see the recessions shaded in dark gray. Now you see very clearly, and in a pretty smooth pattern actually, that every 5 to 10 years, these recessions happen, these dark gray areas, and they are met with a high rise in unemployment, which then peters off until the next recession. Now, I'm making this video in April 2020, and I can almost guarantee that you know multiple people that have been laid off from their jobs. And so you might ask yourself, are we currently in a recession? Since it's measured by two consecutive quarters of economic contraction, it can only actually be classified in retrospect. But what we can look at is the current unemployment. And you do see that it's taking a jump up. But the trouble with this is that unemployment is a bit of a lagging indicator. It takes time for claims to be processed and it to actually hit the system and get reported. So what you can do is look at initial claims. And when we look at the initial jobless claims for the US for a similar period, like unemployment, you see that initial claims go up during recessions. Prior to the last few weeks, there's been the high 200s, around 300,000 initial claims per week in the US. Jumping ahead to the last few weeks, the numbers are quite literally off the charts. This is the same chart, but accommodating for that massive jump in initial claims. So you see that it went about 10x or 11x from around 300,000 to around 3.3 million in 1 week. And this came with the lockdowns and the shuttering of the economy effectively. Now, if you think that was a lot, the following week it doubled to about 6.6 million, and then you see it in the 5 millions, and as the data comes out, it is shocking. So is it a recession? Honestly, probably. The economic data coming out of China is grim. They went from growing at about 6% to shrinking by about 6%. This is the first time they've had a quarter of economic contraction since they started reporting data in the early 90s. As the data comes in from elsewhere around the world, I'm almost positive that you're going to see contraction in Q1. Now, looking ahead to Q2, chances are it's going to be worse. You see, recessions always have a catalyst. This time around, if it does become one, and I'm almost sure it will be a global pandemic. If you go back to the last one, 2008, the financial crisis, the Great Recession, it was known as, it started in the financial industry with mortgage backed securities and credit crunches. Banks weren't lending to each other or to big companies. You saw the high unemployment. This happened over a much longer period of time, though. I think between it starting to become a problem and, for example, the collapse of Lehman Brothers, it was actually something like 18 months. Don't quote me on that. But the point was that it was pretty gradual. We've actually never seen something so abrupt. Go back to the one before that, 2001, known as the dot-com bubble burst. This was a bubble in internet stocks, valuations getting pumped up when there was no real revenues. This was a pretty long bear market in the stock market. It was about 2 years of down. Now, while there's similarities, the common saying is that history doesn't repeat itself, but it rhymes. Uh, some analysts and some companies, even the likes of Ray Dalio, are saying that you may not have seen something as severe as this economically since the Great Depression in the early 1930s, and that is quite severe. You can pull small similarities and analogous periods from past recessions and global issues. None of them are going to be the exact same, but you do see the common threads of incomes and employment shrinking, unemployment going up. In the stock market this time around, we saw the single quickest 30% drop in the S&P 500 ever. Now, this was marked by rapid downward movement, followed by quite a substantial recovery. We're now seeing stocks down only 15% from their all-time highs. And if you take a look at measures of how expensive stocks are, like a price to earnings ratio, for example, the Shiller PE, which is a cyclically adjusted PE, you're going to see that stocks are very expensive still, well over 20. So this makes me wonder why they're so high. I think people, analysts and pundits are looking at metrics around the health data, and we're seeing some recoveries. We've got some optimism about economies opening back up. But what I haven't seen factored in too much yet is the economic data. There's some talk as if you can just flip the switch and turn the economy back on. But for anyone who's ever been in business, frankly, you know that it takes a long time to do hiring, to make decisions, to make purchases. This is not going to be so simple as that. And my fear is that the unemployment will kind of snowball, and maybe we make it out of the pandemic okay, but you're going to see very likely a severe recession. I don't think the stock market is very adequately pricing that in right now. In terms of potential upside, we are seeing massive monetary and fiscal stimulus on behalf of many governments around the world. The United States are making headlines for their largest stimulus packages ever, and the Fed saying things like nothing is out of question. So you are seeing recently that they're buying companies' bonds, like they just supported Ford in billions and billions of dollars of bonds. So in past recessions, the bottom has often been marked by the start of stimulus. So the market could go up, it could go down. What do you do? Well, honestly, don't sell anything. If your time horizon is more than 5 years, don't sell anything. I'm not a financial advisor. You should seek a financial advisor's help. They know a lot more than me. But what you should do, honestly, usually if your time horizon is more than 5 years, the stock market's going to be back up, and if you sell now and then it just continues to go up, you're going to lose money. If you sell now and it goes down, then you'll feel good about yourself, but it's really tough to tell which direction that'll go. So probably just hold on to your equities and your bonds, whatever you own. In terms of buying, if you have some money set aside, well, again, is it going to go up? Is it going to go down? No one knows. So you can dollar cost average your investments. You could invest in tranches. You could invest a little bit now. You could wait to see what the market does, and whether it's weeks or months down the road, invest some more, invest some more, invest some more. That way, you're not going to get the exact bottom, but you're not going to miss out if stocks start going up. And you will get lower prices if they continue to go down. It's kind of a win-win. If you're a little more savvy and you know how to look at companies' financial statements, you know how to do financial analysis, then you can start to look at an individual company and ask yourself, what is what you put as a true valuation, a margin of safety price? You could do a discounted cash flow analysis. You could do a kind of payback time analysis. There's a number of different valuation methods out there, and you can say, what is the price that I'm actually willing to buy this individual stock at? And if it's a good company with great management, they've got growing earnings, they've got low debt, ideally less than 3 years worth of free cash flow. If they are not doing outrageous stock buybacks, but like using debt to buy back stocks at all-time highs, that's a sign of bad management. If they have a big cash pile, if they are a company that has a moat and is going to have some sort of intrinsic value that gets this company through the storm and also keeps it in business for the next 10, 20 years. If you can do that kind of analysis and look at an individual stock, then all the power to you. The folks out there like Warren Buffett and Howard Marks, Guy Spear, the list goes on. These value investors do beat the market, but it is not easy. You need to do much more than all the things I just said. And honestly, before you buy any stock, any index fund, anything like that, do your homework. Understand what the holdings are. Understand how the business works, its financials, and then you can feel confident about making an investment. That is what I do. I don't recommend it for everyone, but if you are going to take that approach, learn about value investing, learn about financial analysis, and then you can make some informed decisions. To recap, a recession is a broad economic downturn that is prolonged, where things like incomes and spending go down, unemployment goes up, and other things like credit tighten up. It's accompanied by a bear market in stocks, where prices go down and opportunities to invest are presented for companies with great management and clean balance sheets. If you want to join me in continuing to learn about personal finance and investing, please consider subscribing and hitting the bell icon to get notifications when I release new content every Thursday. If you got something out of the video, give it a thumbs up. It really does help, and I appreciate it. Thanks so much for watching.